geopolitics, if you want to call it that, has had a huge effect on sentiment. We've clearly got a challenging situation that's in the Middle East at the moment that's causing a lot of hesitancy. You could argue that in some instances it is a seller's market. It's where there's caution or uncertainty that the spread of views on pricing is enormous.
Welcome back, guys. Today we're joined by a special guest, Will Clough from Allsop Auctions. Now, for us, auctions have been a huge part of what we've been doing within property. Our first auction purchase was actually in December 2001, where myself and Sanjay purchased a mid-terraced house, and this is how our journey began. But before we start, Will, well, firstly, thank you for coming and taking time out. Before we begin, do you want to give the viewers a breakdown on like who you are, how you got started within this whole property sector, and how long you've been in Allsop Auctions?
Sure. Well, firstly, thanks for having us. Pleasure to join the Savoy's crowd again. 2001, I was still at school when you were buying property, so I haven't been around as long as you. I joined Allsop in 2010 on the graduate scheme, and I've been in the commercial auction team coming up for 13 years once I qualified into that team.
Oh, wow. So the last 15 years, you must have seen quite a bit of change within the auction market, in particular commercial?
Yeah, I think you probably don't know at the time. When I joined 2010, there was still a lot of banks working out a lot of problems. And I joined and worked under Alex Neil's wing, basically. He was running a huge amount of the insolvency sales and receivership sales, probably a third of the catalogue then. And at the time, I didn't realise that was abnormal. And I didn't realise that the catalogues were probably smaller than we were going on to see. So a bit of insolvency work at the start. And then we went into a booming few years, really, with a lot of portfolios being traded, the loan books that were bought and certain assets traded out. And that was probably 15, 16, 17. Clearly, a lot of finance available at the time that subsequently we've come to find has dried up a little bit. But it's the same faces that have appeared along the way. Some of the old guard are still there doing it their way. You have people that sort of come into the market for a while and leave, but there's a good continuity of buyers and sellers in the market, but refreshingly, there's always new people. And I think that's the joy of what we do.
So in terms of the properties that were coming on back in 2010, for me, I remember that period is after the 2008-9 financial crisis. So was it repossessed stock that was coming on?
Because I'm in the commercial side, it was still a lot of income producing assets, which is what our buyers have traditionally looked for. Yes, there were vacant ones. Clearly, a lot of tenants struggled on the way through as well. And they were from £50,000 vacant shops more regionally through to some bigger, well-located assets and pretty sought after things that had just gone wrong for someone.
Now, when I actually started looking at auctions and I ended up entering rooms such as the Allsop ones and some of the smaller ones such as Athol's, I used to hear a certain term, blue chip company, this is basically the type of property that you want. And I remember when I spoke to brokers, I'd be like, I'll purchase this commercial with uppers and it's tenant and this is what it's producing. The first thing they'll ask me, is it blue chip? Now, does that actually mean much today? And probably, well, some of the viewers may not even understand. Can you explain what it means by blue chip?
The blue chip phrase was bandied around quite a lot, and it was a mark of security, of financial stability from the tenants. It was more the safety of your investment. If you were buying a blue chip company, you were pretty much guaranteed the rent on a commercial basis, 4 paychecks a year, fully repairing and insuring. I'll buy it and I will not have to do much on the way through. So it was the rubber stamp, the old trading chip, I guess, the rubber stamp of security. You'd pay handsomely for it back in the day. Clearly yields have shifted a little bit versus the less secure companies out there where you'll get a better return, but an increased risk of potentially a few headaches down the line.
So typically when you joined, these will be like your Lloyds, your HSBCs, your Barclays Bank, NatWest, Royal Bank of Scotland. I guess they wouldn't be classed as blue chip today?
I think we did a huge amount, prior to my time, of sale and leasebacks. I think it was over 2,000 banks that we sold on sale and leaseback basis. And probably you couldn't get much better than that. And the yields that were paid then, some in the 4% and a little bit softer than that. Bank leases have got shorter. they were all 15 plus leases. Now banks seem to be renewing on 5 with 3-year breaks. So it's not necessarily the security of the tenant, it's more the length of your income and the security of that income beyond the break or whatever it might be. We've seen so many banks go empty. Regularly our lists going around with closures and as they consolidate into smaller branches. And then the next phase of that was probably vacant banks became Pizza Expresses or restaurants or things like that. And Pizza Express would take 25-year leases. And they were in the gold standard of tenants and big rents, and it was the new casual dining fad. So whilst one avenue closes with the banks, there was always another avenue that opened up, and those restaurants are probably now coffee shops or something like that down the line.
Sure. So in terms of, when looking at the catalogues before, you used to have a lot of banks. There's a certain trend for a certain type of tenant that will be in there. Now with banks exiting, like even Boots and other chemists all shutting down as there's accessibility to a lot of these products they sell online. Have you seen a trend to other retailers that have come into these commercial spaces?
I think going back to the original point that our market was traditionally retail, because the private buyers understood it. You can have a look at footfall and see whether a store's trading well. Generally, shopkeepers are willing to give you time to have a chat with them. It was harder to understand in what became branded the alternative sector, I guess. But to chase the returns, and particularly the rental growth over the last 10 years, our buyers have had to become more comfortable looking at what you'd call the alternatives, the veterinary practice, the doctors, the dentists, the roadside assets, things like you say that can't be done online. And it's probably evened out the yield profiles across the board from retail was the golden child of the investment world. Well, industrial had and has continued to have huge rental growth and yield compression. And the private buyers who were perhaps priced out of that market are looking down those alternative avenues.
Now, 2013, 3 years into your career, was quite an important part in the commercial sector. For us, it was quite pivotal because some new set of rules came in. We had prior approval for changing Class B1A commercial buildings, offices, space into residential. How did you see that impact the way you guys worked at Allsop?
It was certainly something that was anticipated, discussed, and not analysed, but how is this going to impact it? Well, in many places, it will depend on underlying values. So whilst it worked in many places and to huge benefit from people such as yourselves, it wasn't a blanket golden ticket to regeneration or profit or anything else, because certain assets, although you could get it, probably wouldn't be suitable to it. But it certainly utilised space that was becoming redundant, in all honesty, and people became pretty skilled pretty quickly at doing those conversions to a high standard, but for a lower cost. As soon as people can start scaling and have their own in-house teams, a lot of people did very, very well out of that PD sort of opening up of redundant office space.
I think the high street itself was, in my opinion, dying. And in 2020, COVID basically did to the high street what would have probably happened in 5 to 7 years. Basically, immediately, it sort of forced people to move online that weren't online. And the ones that were using online and using retail shops, they just moved fully to using online. This must have brought an influx of properties onto your books?
I think COVID, if you put it in general, the biggest impact was on retail rents. And subsequently, there became a bit of an imbalance between people striving to get into certain locations, as you say, versus, hold on, what's the affordability structure of it? So yes, that had an impact on it. But going back to the previous point, I think planning is often the biggest barrier, the slowest barrier for people maximising value of their assets. So the opening up of that, the relaxing of the use class, just freed up a bit of that sort of caution that buyers might have, if you want to call it that, about making an asset work for them. And so much of the high street was owned by the institutions. And as rents sort of declined and stabilised, and we have seen growth in certain places, they became sort of to a point where they were offloading certain assets because the time to manage was too much. The upside in the short term wasn't big enough. So that opened it up to buyers such as yourself and your clients. So we have a much more fragmented ownership of high streets now, but with that comes a bit of creativity from people. The key is to having a sort of a placemaking thing, because you don't want to be the standout one on the street where everything else is commercial and you might have gone a different route. I think it's more of there still needs to be that collaborative sort of placemaking, if you want to call it that.
So we actually find with the introduction of Class E, basically amalgamating a bunch of use classes into one use class, made it a lot easier now for us to actually look for opportunities and to make a lot of defunct commercial spaces fit for purpose. We actually purchased one in Buckinghamshire from you guys, I believe about 18 months ago. It was a huge Lloyds Bank spread over 3 to 4 floors, but it was clearly not fit for purpose. We've then split the commercial unit into something that was business rates exempt, and then being able to repurpose the rest of the building to 3 large flats. And for us, this is something that is more in need for the high street, and it actually brings now people to the high street. Is this something that you're seeing from the clients that you work with?
We had a few vacant banks in, if it wasn't the June auction last week, I think it was the May auction, in old red brick, fantastic buildings in town centres, and they were hugely popular. And I think the ability for buyers to add value is really one of the huge drivers of demand at the moment. Clearly, it's got to be priced accurately on the way in, but as you do, there are many other people with an eye for creativity, with an eye for value add. So it is, in many ways, bringing old buildings back to life. It is benefiting the community in many ways. Is it necessarily benefiting the high street per se? Well, if it takes a redundant building into a scope where it's being used, then arguably it's having a positive impact on rents because there are fewer available buildings. So you could argue that, yes, you're doing well out of it, but it is benefiting the wider high street as well and other owners.
Another strategy for commercial, probably not as widely used as just straight commercial or residential, is the hybrid model, as we call it. It's where you basically use part of the building, retain part of the commercial building, maybe the Zone A element of the retail unit. The uppers, if it's a Class C3 residential use, you can actually change it to C4 under PD rights, and the Class E element, you can basically create residential units from it. And it's a great way of producing a higher yield and then getting a commercial valuation. Are you seeing many people looking at that strategy?
I think, take out the development bit, the shop and upper parts is a classic commercial auction lot. It's that slight spread of risk. Clearly the upper parts are the bits that have seen most growth in the last 10, 15 years, particularly if you're talking in Greater London. But yeah, people wanting to add value, generate as much income out of the building ultimately. And if you go down the HMO route, clearly you will generate more out of it than you would do if you'd made it into 2 flats. With that comes a bit of management cost. Got to know what you're doing. Some certain local authorities have heavier regulations and requirements, but we do see people do that continually.
Oh, amazing. Now, with 2025, it's been an interesting year. What do you see the outlook for the rest of the year?
I think it's geopolitics, if you want to call it that, has had a huge effect on sentiment, not just in the commercial property market, but in the wider, even if we just focus on the UK sort of investment culture and outlook. Stability would be nice. We've clearly got a challenging situation that's in the Middle East at the moment that's causing a lot of hesitancy. So our buyers are mostly privates. They are mostly medium to long term. Even if they're doing the development, they're not always trading for a profit. Some are, obviously, some are willing to hold. So I think people like stability. We're probably back to the old-fashioned fundamentals from their buying side. There isn't a huge amount of correctly priced stock around at the moment, because I think some sellers might perceive that yields will harden going forwards, and actually, unless I've got a pressing requirement to sell, then they're not hugely motivated, unless they've done a lease event, unless they've retiring or there's divorce or certain other things. And on the buy side, there's a huge amount of money there, but it's cautious with a small c, waiting for the right opportunities, Whereas I think some of the opportunities are there and people are probably just waiting, thinking actually now might be the time. So we've got smaller catalogues at the moment because of the lack of availability of stock. We've got a huge amount of demand. And it's our job, as always, to match expectations on both sides of the fence and understand why someone's selling and why someone's buying and what are their plans that they want to do with it. So I think there isn't a silver bullet that's going to free up everything and we'll be back to where we were. But I think it's just a period of stability. Interest rates were obviously held again today, but I think there's a perception that they are going to ease. Clearly, inflation is the driver of that, which has ticked up a little bit. But there's a hope that sort of the brakes will be eased a little bit as we go into the autumn and into the back end of the year, because there are people willing to do deals on both sides of the fence.
So at the moment, I look at the market and it's a buyer's market, in my opinion. You know, there's fewer buyers out there. Some of the bigger players aren't actually prevalent in the industry. So do you think at what point do you think it will become a seller's market again? We're looking 2 to 3 years or maybe longer?
I could look back at my short career, relatively speaking, and we haven't had more than about 2 years without the EU, the Scottish referendum, the Brexit vote, the implementation of Brexit, wars, COVID, various other things. And the swing happens quicker than people think. And people become accustomed to a certain market and they do run out of patience. And they think this money is sitting there. And if saving rates and the risk-free rate starts coming down, people will have to start having a bit more impulse to buy. So I don't think it's necessarily there's going to be a switch that's flicked. I think for the right things at the moment, it's a seller's market for the right products, for the long income, for the indexed rent reviews, for the add value. You could argue that in some instances it is a seller's market. It's where there's caution or uncertainty that the spread of views on pricing is enormous. So I don't think it's going to be 2 years. I don't think it's going to be overnight. And it will be somewhere in between. But we wait for the next event to get in the way.
It's actually just listening to that, you realise how eventful probably the last 7 years have been, and we've actually been through quite a lot. And to actually make it through that, being in property as well, is probably a big achievement. Will, thank you so much for today. Look, guys, if you're interested in commercial to residential, even the hybrid model that we implement, we've got something special for you. Click the link in the description. And if you enjoyed this video, hit the bell icons, like and comment, and we'll be back each and every week.